In our last episode, we discussed sequence of return risk and how it can devastate your retirement plans even before you retire. What we did not discuss was the currently popular so called bucket strategy and how that promises that you avoid this risk entirely. So hit that subscribe button and join me today to examine the merits of this approach and see if bucketing makes sense for you right here in the red zone. As red zone investors become more cognizant of risks to their retirement, they are educating themselves on sequence of returns risk. Sequence of return risk is the risk that the order in which your portfolio returns start out are overly negative. When you combine that with having to sell those declining assets in retirement to generate income, it can lead you to realize your worst fear, which is likely running out of money. But in our last episode, we offered up the 4% rule as a mitigation tactic, which states that a 50 stock, 50 bond portfolio allocation, we can safely withdraw 4% of the portfolio's starting amount, adjusting upward over time for inflation, and we can have a very, very high confidence of never running out of money. A recent popular variation on this 4% rule and any withdrawal tactic in a decumulation strategy is to create time-based buckets, dubbed a bucket strategy. Now, theoretically, the idea is simple and straightforward. In the first bucket, we have cash, where out of this bucket, anywhere from 2 to 5 years of spending can be covered. In our second bucket, we hold bonds or conservative investments designed to take care of spending where our cash ends and gets us up to 10 years. And then our final bucket of riskier assets, primarily equities, takes care of anything beyond 10 years. Now, the question that you might be asking, because it's the one that I asked, is how is this any different from what we're already told already? Before the bucketing strategy was devised, it was generally advised to have an emergency fund that ballooned in value prior to retirement to cover about 2 to 3 years in spending, where the rest of your portfolio was allocated to something like 60% stocks, 40% bonds. So, this bucket strategy, in terms of its allocation, seems like the exact same thing to me, just rebranded and packaged for financial advisors. Another drawback of using this bucket strategy as a portfolio mental framework is that it lacks any clearly defined ways of executing this supposed strategy. Strategies encompass ends, ways, and means, and in the case of a bucket strategy, we seem to be coming up short on the ways or how we'll actually execute this strategy. It just lacks the supporting tactics that are backed up by historical evidence of how we should think about deploying our cash and under what conditions we should rebalance. The market is down 2% this year. Do I deploy cash and wait for it to recover? Or should I sell my stocks and bonds because it's only 2% and my cash is supposed to be there if the market's down more than 10%? How long should I wait for a recovery? Do I ever rebalance into the cash bucket? What do I do with this midterm bucket? There's no consistent answer to any of these questions that I can find. So overall, it's an incomplete idea and not really worthy of the title strategy. However, since this idea seems to have a lot of fans, I would like to see if there's actually something there. So I'm going to develop my own rules to make the bucket strategy into an actual strategy and then test it to see if something can be gained from the idea. So, first, from a strategy lens, our means in this case would translate to how large each one of these buckets should be. If your overall income generating strategy is decumulation, then deploying assets to feed ourselves that don't fluctuate, like cash, seems like a good idea. So, how much cash do we need? Looking at the average and median for US bear markets, our worst case scenario for a bear market was 34 months with an average of 11 months and a median or middle value of 19 months. But this is just a bear market. How long does it take for us to get back to a previous all time high after a crash? The longest periods were 5.5 years to recover from the dot-com crash, just in time for the great financial crisis, 9 years to recover from a stagflation downturn, which started in 1973, and 25 years to recover back to market all time highs in 1929. Now, before we get too far, we probably also want to know about the downsides of holding cash. Historically, cash, represented by short duration T bills, has generated a 0.3% return against inflation, while bonds gained 1.6% and stocks had a real return of 6.8%. But that's over the long term. We don't really know what our specific risk period might entail. So if I'm going to pick this strategy, I'm probably fairly conservative, so I'm just going to go with 5 years here. Now, to execute this strategy, we still don't have any rebalancing rules or rules around when we're going to deploy cash, so I'm going to make some up here. Until the cash bucket runs out, if our current portfolio value of buckets 2 and 3 is less than its starting value, then we will deploy cash from bucket 1 entirely to meet our annual living expenses. If the portfolio balance is higher in buckets 2 and 3 than when we started, we're going to retain the cash and spend down our portfolio. Now, once our cash bucket is depleted, we're not going to refill it and we're not going to rebalance into it along the way. It's just meant to address a poor initial sequence of returns. For our second bucket and our third bucket, we're just going to rebalance those annually just like we would a 60/40 portfolio. Now for the test. We'll use the worst modern example we can find by retiring in 2000 prior to the dot-com crash and see where we're at the start of 2025. Our first contestant allocated 60% of their portfolio to an S&P 500 index fund. A popular one in 2000 was Vanguard's VFINX and 40% to an intermediate treasury bond fund. Again, we'll use one from Vanguard, ticker symbol VFITX. Now, I don't know how popular that one was, but of note, it was an actively managed intermediate treasury bond fund, as I couldn't find returns for passively managed treasury index funds until about 2009. Contestant 2 has the same 60/40 allocation, but rather than against $1 million, that's only split up against $800,000 because they're keeping $200,000 or 5 years worth of cash in VMFXX, which is a Vanguard money market fund. Contestant 2 will be following my made up bucket strategy rules because there are no rules and deploying cash when they have less than 800K in the stock bond portion of their portfolio and rebalancing just to the stock bond portion. Both contestants are using the 4% rule and adjusting for inflation, and because their assets are likely spread over different account types, I assumed a 15% tax rate for both of them. In both scenarios, we still have over 70% of our portfolio value, generally demonstrating, if nothing else, the ultra conservative nature of the 4% rule. However, our bucket strategy retained about 125,000 more of its value from 2000 to 2025 than the traditional 60/40. So what can we take from a single example? Not much, I'm afraid, but let's review why this scenario worked. First, our actively managed bond fund served as a big counterbalance to our stock declines. Just as a reminder, that scenario didn't play out so well in 2022 when some supposedly safe treasury bond funds declined even more in value than the S&P 500 that year. The fact that those assets were negatively correlated or moved in the opposite directions the majority of the time from 2000 to 2025 made our cash more valuable, preserving both our stocks and bonds when needed. Now, you could make the argument that having even more cash on hand and less bonds would make the bucket strategy even better if I retire right before a 22 scenario. And I would agree with you if it wasn't a single scenario. We'd need more data. Second thing to take away here, potentially, or why this worked, was that the cash bucket left us with just enough cash to partially mitigate the 2008 great financial crisis decline, which left us with a larger pool once the asset classes reversed course for generally the remainder of the time period to 2025. Third, inflation was low until recently. Fourth, even with that low inflation early on, we got a pretty good yield in our money market account of over 5%, versus after the great financial crisis, we would have started losing money to inflation in our money market account as it was only earning about 0.1%. But we were out of cash reserves by then, so it didn't really matter in this scenario. Fifth, we started with a large cash balance and it survived the most recent worst case scenario. Now, had we needed our portfolio to grow more and we experienced a more typical scenario rather than retiring right into a lost decade, we probably would have limited our growth as our cash would have sat there earning less than inflation during most of the time period. Now, since this channel does not provide investing advice, I'll tell you how I'm thinking about implementing the ideas of the bucket strategy in my portfolio. To start off, I don't plan to use a decumulation strategy to generate income in retirement that would cause me to have to sell assets right out of the gate. So I'm not using 4% or another withdrawal tactic. My strategy is to cover my spending in my initial retirement years through income producing assets. Now, I will have to decumulate some toward the later years of retirement to combat the effects of inflation, but I'm going to use my initial retirement period where I'm projecting not to need to sell assets to kind of rebalance more opportunistically to prepare for when I will need to do so. Now, I say that, but I'm still keeping a relatively large amount of cash on hand, about 10% of my overall portfolio now. First, because it's still earning more than inflation. And second, I'm de risking my portfolio as I approach a potential retirement date. However, once that money market rate moves lower, um, moves under the CPI, I plan to start deploying more cash into my bond ladder and only keeping somewhere between a year or two on hand, which could move that cash component lower to about 5%. I wouldn't go below that amount because I'm not retired yet and could have all sorts of scenarios still occur, including job loss. So, what do you think of the bucket strategy? If you like it, what rules do you plan to use for rebalancing or asset allocation? How many years of cash do you plan to start out with? Whatever your take, feel free to leave a comment below for the community so we can all learn from your insights. If you're interested in other relatively new investing ideas or products, check out this video that I did on covered call funds, where I explore those investments and whether or not they are right for my portfolio. Until then, I'll see you next time, right here in the red zone.